Hello and welcome to another episode of Monday Markets. As always, we're brought to you by Woo. Links available in the description below. Be sure to check them out if you're looking to compare venues for your centralized exchange trading. And as always, do not keep any more funds than necessary with any centralized custodian and use leverage to mitigate your counterparty risk, not put on mega YOLO position sizes. So with that said, let's talk about the monthly time frame. As before, the big monthly levels are at 23k and 20k respectively. I generally like monthly candle bodies more than candle wicks. I think they work better. In terms of how my system operates, for levels, I will almost always use candle bodies. And for spike/reverse/SFP setups, I will use wicks. So if I'm looking for levels, it's bodies, and sort of spikes, it's wicks. It's about the simplest way I can explain it. So with that in mind, how does that apply to the monthly time frame? Well, while it's true that the monthly levels are at 20k and 23k, we are in an area where we could see some wick-like price action because we are currently trading around previous month's low, and that takes us not too far away from June's low. So if the market wants to close this month bullishly, one way of doing that would be to spike previous month's low and ideally June's low as well, and close above them. So you'd have some sort of monthly SFP, monthly failed breakdown or whatever, and some signs of absorption and that the breakdown was not successful. Obviously, that's 19 days away, so a long time to wait, and we will discuss some lower timeframes that might print that signal somewhat sooner. But as far as monthly context goes, if you're looking for monthly supported ideas, they are only available at support at 23 to 20, or if one of these wick spikes turns out particularly favorably. But even then, the monthly time frame probably isn't the best time frame for that. It might be a bit slow. So let's move down to the weekly. Now, similar to the monthly, not only are we sort of trading around these lows, but even more recently, we had 4 weeks worth of lows built up amidst this low volatility. And now the market is kind of spiking and probing below. So I think the earliest reasonable argument to get bullish on the weekly, if the market doesn't collapse, would be something like the following. If you'll recall, we discussed this range low at length as the sort of interim bottom of the range. And I think we talked about it here that, look, whatever bounce we're going to have has already played out and everything else is far less compelling. Now we are below that level. So if you're looking for weekly signals that aren't completely rubbish, or at least some semblance of strength, what I would like to see on the weekly would be, part one of this is done, which is spiking all of these lows. I think the market's achieved that with where it's trading at the moment. But then the second part of that formula would be then closing above the original range low level at sort of 25.9 to 26k. If that were to happen, then you could start to make a decently compelling argument for a failed range breakdown. Essentially, look, this is the range low. We had a bunch of trading built up around it. Those traders got washed out by this candle, but instead of breaking down, the market came back up and closed above the level. So any sellers that were, shorting this aggressively were trapped, and it just looks like a nice reversal setup that the market tried to push lower and wasn't successful in that objective. So again, it's essentially a two-part plan on the weekly if the market's going to be strong, which is that spike all of these lows, accomplished, but there is a second part, which is close above the resistance itself, and that remains to be seen. For what it's worth, I think breakdown continuation is more likely than breakdown reversal. That sentence doesn't mean anything because it's not a trade in itself. But in general, the way I like to view sort of failed breakdowns and failed breakouts is as far as possible within the context of the trend, right? So let's say there is a market that's trending up. It obviously never looks like this, but just for our purposes. And then, the market pushes up from one of these lows and then starts to break down. Now, while it could be true that this is a shift in market structure before the market breaks lower, I'm also acutely aware that it could be a trap to, wash out some of these participants or to, over-eager sellers or whatever else before continuation higher. So my presumption as to whether to trust a failed breakout or a failed breakdown depends on 1, the underlying trend, and 2, is the market trading in a high time frame area of support or resistance. Now, at the moment, if we apply that framework to what we have going on here, what is the trend? Well, I think at least the local trend is down. You could be generous and say it's sideways, but I would be inclined to disagree. So we know that if the breakdown has a chance of being bullish, it's not supported by the short-term trend. And the second part of that test, which is essentially, is it at an area, is the breakdown taking place in an area of support, which increases the odds of a trap, or is the breakout taking place in an area of resistance, which also increases the chances of a trap? And I think, unfortunately, the answer to that is no, because as we discussed on the monthly and on the weekly, the big area of high time frame support is closer to 23, 24 on the weekly, down to 20 on the monthly. This is just a very sort of cobbled together interim range low. And in any case, if I'm going to be making an argument for a failed breakdown, it's not the market breaking down from support that's important, it's the market breaking into support that's important. So if this were a high time frame support of some significance, then I would be much more open-minded towards considering the possibility that this breakdown isn't going to stick and that it will end up as a failed breakdown and a reversal. But because A, the underlying trend is lower, and B, there is an absence of high time frame support where the breakdown is taking place, I didn't have a sort of prima facie compelling case that this breakdown is going to fail. I mean, obviously, again, this is mostly conjecture and to try to explain my framework somewhat. If it closes as a failed breakdown, then of course I'll punt it. But in terms of just assessing the probability of that without evidence, I'm not a huge fan given it's missing those two factors. But if it sets up that way, happy days, jolly good. But that's not my expectation at the very least, and I'm going to need the market to prove it. So I guess one important difference there is if those two conditions were met, let's say the market was generally trending up, and we had the market breaking down into an area of high time frame support, that would be one of the circumstances where I wouldn't mind actually buying the breakdown itself before the reclaim to try to essentially put on an early position. However, in this case, because the preceding trend is not up and we do not have a compelling high time frame support that the market is breaking into, I can't justify buying the breakdown until such a time that it proves to me with more evidence that it's a failed breakdown rather than a real one. So the onus is on the breakdown to sort of prove itself rather than me presuming that it's a failed breakdown based on these factors. That might have been complete nonsense. Please let me know in the comments if it was, but that's kind of how my brain works around this type of stuff. So that's the weekly time frame. We know that the monthly support aligns around 23K, the earliest version of that. I think there is a sort of ubiquitous level around 24K that matches that quite well also. You can imagine if this starts to really break down, there is 24K weekly support, but it's likely going to wick below, even if this support holds. So I think allowing some margin of appreciation for 24.3K to wick lower, should the market keep going, is acceptable. It's not the kind of thing where I just kind of put a limit order at the level and a stop $10 below and assume I'm safe. It's definitely not the right context for that. So realistically, where does that leave us as far as the market until next Monday? Well, here. So the only two things that I'd find reasonably compelling, as mentioned, either the weekly close back above 25.9 or looking for some sort of short-term mean reversion punt around the weekly and monthly levels at 23.3 to 24.3. And ideally, you'd want some good weekly close into that area. I don't want to start extrapolating beyond that because we start to enter some rather extreme scenarios. So specifically, let's say, the market is very weak until the next episode of Monday Markets or Casual Friday, whatever it may be. And, we have a weekly close below 23.3 or even below 24.3. At that point, it'll be quite tough to make a bullish argument because you'd essentially be relying on the monthly time frame to save you. But let's say this closes bearishly like so. It doesn't have to be in one candle, but let's just say the close is bearish. At that point, if we take the macro range between sort of 19K and 24K, we'd be closing back inside that same macro range. And then we have to consider that the other side of it is a reasonable target, right? So I think that's why a lot of market participants not unreasonably put a lot of emphasis on this 24.3 to 23.3 resistance turn support. And I think it's because if it fails and if it breaks, then at least in sort of pure price action terms, all of this portion of trading will have been, just a retest of resistance or a failed breakout. And once the market, or if the market trades back inside that range, then from a trading perspective, you have to reasonably consider the market trading towards the midpoint and the range low as well. So that's why there's a lot of emphasis on 23.3, 24.3, because yes, it's a high time frame level of support, both on the weekly and the monthly, but also because it bears significantly negative consequences for the technicals if we close back inside there. So yeah, that's kind of the outlook for this week. 3 levels to pay attention to. Hopefully nothing too overbearing, and the ideas are essentially straightforward. Let me know if that makes any sense in the comments below, and thank you to those who always comment something like thanks cred or something of that nature. I do see all those comments, and they are much appreciated. I don't think there's anything else really to add on other timeframes. They essentially reflect the weekly and the monthly view. Breakdown is real until proven otherwise. Given how weak the market has been, it really has to prove otherwise, and it's not one of those instances where I'm happy to buy the breakdown in anticipation that it's going to be a failed breakdown. I really need to see definitive proof. And in the absence of that proof, I'm going to let this thing do what it wants to do. It hasn't been doing much as far as green candles go. So yeah, that's the BTC outlook for the time being. Nothing new on the ETH front either. As discussed on Technical Roundup, the newsletter, I think, we're making the argument that ETH is even weaker because at least BTC was holding on to its June lows, whereas ETH has been below its equivalent level for some time now. So this just doesn't look very good. I'm not sure what else to add. It certainly looks weaker than BTC, and BTC doesn't look too great. As far as ETH levels of support, you'll recall we had this mini range here with a mid-range of 1600. That looks to have been retested, which isn't great. And the other side of that boundary is at 1400, which is also like all the way here, the sort of prior all-time high level. So it's not nothing. And if you take the macro range in mind between essentially 1K and 1900 or 2K, you end up with a midpoint of 1500. So putting those two together, if you want to get some sort of reasonably confluent area, you essentially get the 1400 to 1500 area comprised of the macro mid-range, essentially, and the minor range low. So, and the former all-time high in the form of 1400. So if we're talking confluent levels for the majors, BTC 2324, ETH 1400, 1500. Now you're still somewhat diddling in the middle, but at least those levels make sense. Like for the past few weeks, none of these levels from a high time frame point of view have been particularly interesting to trade, hence the lack of enthusiasm and apathy as far as the majors go. But at least getting to those equivalent levels on BTC and ETH, if the market continues to break down, would land us in an interesting spot that's more likely to yield trading opportunities than not. Now, these aren't sort of macro, mega, bottom, whatever levels, but they're the kind of levels where it would be much more understandable if you were punting those rather than punting anywhere in the last few weeks. So that's something to bear in mind. And hopefully you're starting to see a fairly narrow picture of the market come into mind with 1500 ETH making sense below us and 1680-ish above. And on the BTC front, the equivalent would essentially be above us at 26, and in terms of below, 24.3 to 23.3. Yeah, that's really all there is to say. I haven't been paying much attention to ETH BTC because it's been doing nothing, and altcoins have simply been getting murdered. So it just looks bad, to be honest. Like, for example, Sol, one of the biggest outliers today as far as open interest change. I think there's a lot of short interest on that side, but that in itself isn't a red flag unless the market, starts to diverge or reverse. And it really seems like the key swing high time frame levels for Solana are above $30 to $33 or back into its essentially bottoming range from 14 to, if you want to be really charitable, it's 14 to 12. If you want to be more precise, it's 14 to 10. And this thing's just been going down for 5 weeks in a row, and there's some the market's trying to price in some FTX estate supply selling type of thing, and that just hasn't been particularly good either. So I hope we'll be forgiven for not being terribly enthusiastic on the altcoin front, because we like to focus on the majors, and most of them have just been bleeding. And that's really the name of the game. Going through this watch list, we don't even have outliers in this market really, or sectoral trends or anything of that nature. The correlations sort of converge towards one, and it's a bit of a bloodbath out there. If you just kind of zoom out on the weekly and look at the high market cap majors, they've all been going down at different rates, but still going down for the last 5 to 8 weeks or something of that nature. Even a lot of the on-chain stuff has been getting murdered, and those rotations have been as cynical as expected. So we're not going to find much there, to be honest. Nor are we terribly interested, at least on this channel, of shilling you altcoin short setups, because it's a very dangerous game to play. And in your crypto trading career, you'll probably make much more money being long altcoins in the appropriate windows rather than playing God Trader and shorting all of them at the same time. Although, of course, Twitter will tell you otherwise. That's really all I have for this week, unfortunately. Or fortunately, depending on your outlook. At least it was lean and straightforward. The S&P's been going up. We don't care. We don't get to have fun when this thing is strong, so no huge surprises on that note. And the final thing I wanted to mention is in terms of how much of a washout was this move, the answer is kind of, but not really. So for example, if we look at liquidations on the 4-hour and look at where the outsized ones come in. Now, obviously, this bottom wick was particularly bad on the 17th of August. But looking at this move here, now, obviously, it's the highest in some time in terms of recent price action. It's not as many liquidations as on the 31st of August, although you really have to measure these things differently depending on the amount of open interest, so on and so forth. But all of this to make the general point that I don't personally think that these are particularly outsized liquidations where you think, wow, everyone just got crushed and I'm going to get long because the whole thing is flattened. You could get a bit of a mean reverty bounce, but just in general, it's not, as per the high time frame analysis, this breakdown didn't take place into a particularly technically compelling or important area. So even if you get a mechanical mean reverting bounce as a result of these liquidations, initially at least, the only thing it would achieve is trading back into the resistance area. So I think it has to do a lot more and hopefully meet the weekly criteria in order to be bullish. Otherwise, at the moment, given A, the absence of a preceding uptrend, B, the lack of high time frame support that we're liquidating into, and C, what was point C? You know what? I forgot. But given that contextually this whole thing isn't huge. Oh, hold on. Did I just remember? Oh, yes. Okay. So preceding trend doesn't help us because it's been down/choppy. It's not liquidating into an area of high time frame support that would shift the odds from real breakdown into failed breakdown, and we don't have a kind of outsized open interest wipeout on this move. And so given the absence of these three reasons, I'm not hugely fond of just buying the licks. Yeah, maybe that's wrong, but if it is, boohoo, too bad. I'm not shorting this thing, and if it wants to give me a weekly signal, I'm happy to take it. It just has to prove its case to me. That's enough rambling, I think. Let me know if this was helpful. I'm aware this might be slightly longer than usual, but that's all I've got for today. As always, your comments are much appreciated. Like the video, subscribe to the channel, do all that YouTube algorithm stuff. We appreciate your audience, even though I skipped Casual Friday because my life's a disaster. Nonetheless, thank you to Woo for supporting the show. Be sure to check them out as well for supporting your 5th most favorite content creators in the bear market. That's all from me. Hope you have an excellent week, and we'll see you for the newsletter tomorrow on trletter.com. Goodbye.